Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 263rd VideoCast podcast for the week ending October 31st, 2024. Happy Halloween. Mimi and Annabelle are going as a Chick-fil-A cow and a Chick-fil-A worker. And if you zoom in here, I think we can see that Annabelle has a name tag that says Annabelle on it, which is pretty wild. So that's fun. Then, last night got to go to Sistina, which is a great restaurant in New York. If you're ever through New York, you definitely want to check that out with my friends from Dallas, Chris and Brian. You know who you are. And this is the chef and owner. This is Giuseppe Bruno, and he owns that and Caravaggio. He's always there. I had a chance to meet him for the first time when I went with Ellie Terrett and Charlie Gasparino sometime back, and so it was nice to be back. You couldn't believe the number of specials they had. Number one, I don't know how the waiter remembered all of them, and number two, we thought we were on candid camera like it was a joke. There were literally like 30 dinner specials between the appetizers and the main course. So like everyone else, we just ordered a cheeseburger. Just kidding, not exactly. But leaving that aside, moving along, we want to get down to the charts of the week. We've got a tremendous amount of stuff to cover here. First off, the misery index, which is the year-over-year CPI plus the unemployment rate, is approaching low levels that we haven't seen since the bull market in 2014 through 2019 and the late 90s. This is interesting. The CHIPS Act could cover nearly half of all factory costs. So you can see here the breakdown of Intel getting the most money. This was a bipartisan bill that will be followed through. We're going to talk about Intel thereafter. Hours earnings were pretty phenomenal, or at least a step in the right direction. So they got $8 billion in grants, another $2 billion from military grants and contracts, another looks like about $10 billion of loans, and then tax credits of about $25 billion. So and they haven't got one red penny of this yet. So they're going to start seeing this come in, which is going to help them. They've started to turn the ship on their own. And then when you get this rocket fuel in the jet, they're going to rock and roll. Now, 1976 to 2023, S&P 500 seasonality. You normally get this kind of weakness right before the election. Like we're seeing October broke the 6-month winning streak for the S&P 500. The month closed negative. You should expect that at the end of October. This is the dark blue line for a presidential election year. And then right after the election, you tend to get an awful lot of strength in November and December, even in non-presidential years, but certainly in presidential years. So that's an opportunity and so on. This is from Mike Zaccardi. Regional banks surged 15% and 17% in the previous two election months, meaning November of 2020 and November of 2016. Those are huge moves. That's also consistent with what we've been saying, that small caps do well in November and December. So banks, KRE will be a big beneficiary of that as well. Some data here. The GDP growth rate still at 2.8. So all of those calling for the recession didn't actually get it because we have the growth still coming in pretty aggressively. Inflation continues to come down. Core PCE came in at 2.2 today. Real consumer spending was up 3.7%. So the consumer is strong and confident. Intentions to purchase automobiles in October was the highest level going all the way back to pre-pandemic for the first time ever. That is pretty exciting. And we'll see the jobs report tomorrow to determine whether the 96% chance of a 25 basis point cut in November is accurate. But one thing that one of the listeners forwarded over the week was from the Ford earnings call that they were talking about an estimate for a SAR that is much higher than Cooper Standard is calling for. By the way, it's my great mug, Hedge Fund Tips. Remember, opinion, not advice. Go to hedgefundtips.com and click on terms. So in their earnings call, Ford said, our outlook for 2024 assumes a flat to slightly higher SAR in both US and Europe. Our planning assumptions for the US is 16 million to 16.5 million units. That means production is going to ramp up, and the biggest beneficiary will be Cooper Standard. So that's pretty exciting to see. And that's from Ford. Next, this shows that we had 5 straight up months and closed a negative month in October, which is pretty standard. You can see here the NASDAQ seasonality as we discussed. Same story, week in late October. Small cap, same thing. And then very, very strong. Small caps tend to be extremely strong from November and December. This is from Seth Golden talking about those. The election return from October 27th to December 31st for S&P during election years is plus 6.25%. When you go down to NASDAQ, it's 7.17% for that basically 2 months and 3 days. And if you go down to small caps, you get the highest returns in the shortest amount of time of 7.99%, which is consistent with the regional banks, which is a big part of small caps. Moving along, mentions of bottom surged, which historically indicated a bottoming EPS cycle. If you remember, we've been talking about the Q3 pause in earnings before the re-acceleration. And the last time you saw pauses like this was at the bottom during COVID and the bottom during 2009. Mentions of bottom have skyrocketed, so that means earnings are going to aggressively re-accelerate, and particularly in the unmagnificent 493 relative to the magnificent 7, which we saw in the last few days. They continue to overspend and their margins are coming down a bit. While the rest of the S&P 500 is going up. And we're going to see that in a pronounced way in Q4. And the market's going to start to discount that right after the election certainty clears. Job openings by establishment size. So you can see labor pressure is coming down. Job openings are less. So employers will be able to have more influence over what they pay for labor. Dallas Fed Manufacturing Index turning up. This is consistent with our recovery from the manufacturing depression moving forward. And then October 2024, new vehicle sales forecast. You can see here 7.9% year on year, and then a huge rebound from September, up 10%. So that's going to be a big deal. That should pull forward some production for Cooper Standard, and it should be a positive thing to see. Global manufacturing PMI is turning up, so that global manufacturing recession should start to reaccelerate. The recovery should start to reaccelerate. Medium floor area decreased as far as square feet per houses, and this is what I had talked about in terms of all the millennials not needing to have a starter home at 3,500 or 4,500 square feet. And home builders are starting to cater and starting to provide a lot more of these 2,100 square foot houses like you saw more than 15 years ago and then in the early 2000s. And then we talked consistently about Levittown after World War II. And that's a normal thing when you have a huge portion of the population starting families to get reasonable sized houses so they can afford them, start the family, and trade up over time. UK births have fallen to the same level as deaths. We haven't seen that since 1976, but yet they're having their biggest annual growth in population in 74 years. So a lot of migration going into the UK. That should be constructive for GDP, etc. Biggest outflow from China equity funds since June of 2015. This is pretty wild because, okay, I didn't pull that chart up, so I'm going to have to do it here and here. So let's just use KWeb as a proxy for China tech. So this was the last time you had an outflow as big as you've seen now. And then what did you have? You had the KWeb triple. You probably had BABA triple over the same period. Yeah, 2015. And then it tripled from 55, not tripled, quadrupled to 207 in the next year and a half. So back to the future, ladies and gentlemen. Pretty exciting to see. And then, speaking of which, they are having an enormous government meeting to basically determine the size of the stimulus that's going to come. And they've had monstrous estimates if Trump gets elected to offset the perceived threats about tariffs. Speaking about the perceived threats about tariffs, I posted this chart over the weekend that got a lot of hits and was misinterpreted by a lot of people, but that's on them. But, you know, there's been a lot of fear about Trump getting in and putting tariffs on China and what that will mean for Chinese stocks. And what I could say is, in 2016, there was a tremendous amount of fear about President Trump getting elected and putting tariffs on China. And when he got elected, he did exactly what he said he was going to do, which is he put tariffs on China. And what happened to Alibaba over the next first off, the first year and a half while he was in, Alibaba doubled plus, up 150% from 84 to over 200 and change. And by the time he was out, it was up almost 4x from 84 from when he got in to it hit 312 during that same period. And then when the new administration came in, it collapsed from 280 down to 66. And, you know, a lot of people said, well, correlation is not causation. And to that I say, no S, Sherlock. But the point was that the same euphoria around tariffs proved to be unfounded as it related to the abilities of these companies to earn in their countries. Number one, certainly a BABA, a KWeb, etc. And number two, the studies that I've read about tariffs is even if he went full bore and did a 60% tariff and it wasn't just a tactic to negotiate with Xi, he actually implemented it. It would have a negative impact on Chinese GDP by 1%. I would have thought it would be like 10%. We overestimate our influence on their economy. And on that basis, what they are planning, which will come out, I think it's the 5th to the 8th, they're having the big meeting, I guess, to see who's going to be elected. So if Trump is elected, the stimulus is probably going to be 5 times bigger than if Kamala is elected. And meanwhile, the policies of Kamala would be more deleterious to the Chinese because it's an ideological type of kind of creating a Cold War versus a pragmatic philosophy of eye for an eye. If you're going to tariff us, we're going to tariff you, but we're still going to do business and move ahead because we want to make money and we want to create jobs. So this chart, I think, is very important. Same frenzy. As a matter of fact, it's funny because BABA was in the same type of bottoming process, breaking out, and then taking a little breather before taking its big run. And this is a very similar situation. So I love seeing that. I also see it on gold. Biggest inflow to gold funds since July of 2020. Well, the last time you saw that inflow into gold at this level in such a short period of time was early 2020. And what was that? It was called a top. And it basically collapsed about 30% overnight, and then, or 25%, and then continued downward. 20%, then continued down 25%, and basically never hit that new high for 3 more years after correcting 25%. It's not to say this is the exact top. I would just say this is not the time to be chasing it. You can see the last time you had this many consecutive trading sessions above the 200-day moving average. Again, we were closer to the top than the bottom. And then if you look at commercials, while all the hedge fund guys and retail guys and small traders are buying it like it's going out of style, the commercials and the smart money are selling it. So that doesn't mean it turns on a dime. It just means that you're better off to be laying off than adding. U.S. consumer sentiment rises to 6-month high on rate relief. We haven't seen it show up for the consumer yet, but it will over time. And that goes back to, which will cover the seasonality of bonds. Everyone is mistaken that they cut rates and bond yields are going up and they're going to keep going up. And then people are trying to justify it. So they come up with this narrative. It's because of the high debt, or it's because of the Chinese selling bonds, or anything else. And sometimes it just has to do with the supply in the market that happens every single October. And we'll look at the seasonality in a minute, because October is the worst month of the year for long bonds, i.e. prices go down, yields go up every single year. And then November is the best month of the year for bonds. So sell the rumor, buy the news. You want to be a buyer of bonds into this weakness. Yields are going to come down over the next 2 months, not up, no matter what all the Cassandras tell you. That's what's going to take place, or that's where the odds are relative to what's going to take place. University of Michigan, inflation expectations collapsing. U.S. Economic Surprise Index skyrocketing. U.S. dollar, this is a counter trend move. Again, I repeat, a counter trend move. It has been grinding sideways here after falling, and this will start to recover its weakness, and the euro will start to rally along with all the other currencies over time. Japan, and maybe sooner than we expect, maybe starting next month when we see bonds rally. Japan 30-year government bond yield continues to go up, which means the Bank of Japan is going to have to continue to hike, and that will be very constructive for China, very destructive for Japanese equities. Biggest outflow from emerging market equity funds since April of 2000 rather. And if you go back to April of 2000 and you bought emerging markets, you made one of the quickest doubles in the shortest amount of time in history. In basically less than a year, 9 months, you doubled your money. Sentiment indicator, and by the way, the biggest weight is still China. Sentiment indicator is stretched, but not insane, according to Goldman Sachs. Moving along, correlation of the S&P 500 versus the S&P equal weighted index is at record lows, not seen since when? Since 2001 and 2002, the analog that we continue to point to for all of the ways that we're positioned to take advantage over the next few years and are starting to see. Slowing earnings growth for the Magnificent Seven. So you could see here, 50% earnings growth has dropped down to mid-teens, whereas the Unmagnificent 493 had basically negative earnings growth and has now flipped to positive and is reaccelerating to mid-teens. So you want to go where the growth is going to be happening versus the deceleration. And we saw that this week in the Mag 7 getting smacked today. 10-year treasury yields. This is a counter trend move. Even Goldman Sachs agrees with me, pointing to a 3.85% target moving forward, down from the 4.2 and change where we are at now. I agree. Hedge fund asset managers turn dollar bulls on election risk. Again, this is a counter trend move. It will get resolved in coming months. And the age of population across different countries, which is very interesting. We've been bullish on China. We think China's got a great run for the next few years. And the US, why? Because the bulk of their population is age 34. And you can see it played out in the numbers right here. China's this navy blue line, and U.S. is basically this red line here, right around the exact same age. So China's a little bit ahead. That's why I think they've got a 3 to 5 year run. And I think U.S. has another 2 years. I think we've got a 7 or 8 year run, effectively straight up because of that population advantage. And then you look at other countries like, and Britain is also in that favorable situation. Other countries like EU, Japan do not have that advantage. They are beyond the beneficial years, and they're going to continue to be slow. Dallas Fed manufacturing. The advantage that the EU might have over China is that they can import more people, more immigration, which could help them in terms of population growth and age demographics, which could really help them from a labor force standpoint. Dallas manufacturing, we covered. Most positive reactions to beats since Q4 of 2018 so far. Long short equity funds, very long U.S. stocks, which is when they say stocks and equities, they're referring to concentration in the S&P, which is effectively Mag 7. And when you get that overweight, like we saw in late 2021, what happened? Tech got shellacked, and we saw indications of that, which is why we took off most of those positions in July after huge runs and the tail ends in the past couple of months. So Treasury yields versus WTI crude. This divergence always resolves. In 2022, you had the opposite divergence. You had WTI at a peak and Treasury yields at a contraction. Now you have Treasury yields way up and WTI crude way down. I think this resolves. I think they're going to wind up meeting in the middle. Yields are going to come down meaningfully, and energy probably starts to go up. U.S. job openings. As a matter of fact, it's interesting. Trump was talking about helping the oil industry by having OPEC cut barrels, which is kind of interesting because I guess the energy industry got wise to him and said, "Drill, baby, drill doesn't help us. It may help you. It doesn't help us." So maybe there's a compromise to be had there. U.S. job openings, again, JOLTS collapsing, which gives the employers more pricing power for labor. Quits rate has gone down. People are not quitting their jobs anymore because they can't name their price across the street. And perceived likelihood of a recession over the next 12 months dropped to a new low in October. Hedge funds are very short on green stocks. You know, I continue to look at some of these solar stocks and others because people are so short, and the opposite of what people are expecting. People think if Trump gets elected, energy stocks go up. When he was in last time, they did terribly. Green stocks did horribly under Biden. People thought they would do well. They did better under Trump. So I think there might be a pony in this pile. I don't know if it's EVs or solar, probably something in solar. So we continue to look. Maybe the way to play it is the way that we have with the starter position in Albemarle and just kind of deal with the picks and shovels related to these themes. That's probably the way I'll wind up playing it. But U.S. tech stocks have been seeing more frequent fragility events, with 2024 currently on track to have nearly the most since 1992. Sigma moves with magnitude greater than 3 for tech stocks in the S&P 500. Fragility events are also more extreme in the magnitude for the largest stocks of the S&P, currently exhibiting their largest magnitude since 1992. So basically, they're saying the Mag 7 is vulnerable based on this data that they're collecting. Mentions of bottom surged, which is historically indicated a bottoming of the EPS cycle, which we saw up further. We'll cover that again. Initial jobless claims have come down, so that's something to keep an eye on. We'll see what happens with the jobs report tomorrow. We need it to be a little bit weak, but not too weak enough to keep the Fed on track for the November cut. Although one worries based on the election outcome that they might be influenced to act in one way or another. But let's just see the data. So far, they've been data dependent, so let's hope that continues. Wanted to show you some seasonality of a few of the names we've discussed on the podcast, some of which we own for clients and personally. Cooper Standard, you can see the best time of the year for Cooper Standard stock happens to be the end of the year in November and December. TLT bonds, again, last month is the worst month of the year. This month, November, is the best month of the year. So we should see some compression in yields. Regional bank stocks tend to have their best 3 months, October, November, December. That's consistent with small caps. In November and December have monster months. And then biotech is supposed to have a big month in November. Historically, it does. Advanced auto parts does well with small caps in December. And even Estee Lauder, which got shellacked today, we're thinking about making it a more meaningful position. Bought some stock today, doing some work on that. It's never been a big position because it's too correlated to China and Alibaba, and we have enough exposure there. But I think now it's a high enough quality business. They've got the new CEO. He'll probably have one more kitchen sink quarter, the first quarter that he reports on, and then the thing can start to move and turn with China. And it may turn quicker, which is why we're opportunistically taking advantage. Intel. They just reported after the bell. The stock was up big. November is the best month of the year. They're up 100% of the time in November. So I think we're going to get some follow through with the after hour spike, particularly after the election. Etsy is a new position that we have not disclosed on the podcast that we entered a couple of weeks ago. I think our basis is somewhere in the 49s and change. We'll probably have another chance to buy it in the 40s, but it's a nice sized position. They had great earnings. We're not going to do anything comprehensive on that yet, but just putting that out there. Seth Golden talking about small caps looking good. Haven't broken out to new highs, but crawling their way higher. We've been talking about that for a while. We had the seasonality here. And then the first 10 trading days of November are amongst the best trading days of the year in a presidential election year. This is right here. So that's the best 10-day period. So we'll see how that plays out this year. Weak demand mentions are tracking at the lowest level in 2 years, meaning demand has reaccelerated across the S&P 500 components. Mentions of bottoms, which we discussed. Indicators suggest a 12% year-on-year EPS growth in Q4 versus 10% consensus. So Q3 is the pause that refreshes Q4. It's looking like earnings are going to come in even higher than the street is expecting on the basis of this data. And then here is the Mag 7 and 493 are all slowing in Q3 and then re-accelerating in Q4, which we have touched on. Pause before re-acceleration, and you can see by sector, energy is going to be the most negative this quarter, also negative next quarter, and then starts to re-accelerate next year. They'll start to discount it. Industrial's negative this quarter, then starts to re-accelerate meaningfully next year. And then materials re-accelerate starting next quarter. So that's like the Albemarles of the world will start to really do well. Healthcare should re-accelerate weak quarter. This quarter should start to do a lot better. Consumer discretionary, which we've talked about a lot, comm services and utilities. So that's a good roadmap. And then worst inventory destocking cycle is likely behind us, which we talked about. So you can see here, and this is just the beginning of the recovery when you see it move back up to that baseline like you did in 2003. You had 4 more years of rally like you did in 2011. You had 9 more years of rally like you did in 2000, and then you had another 2 years of a rally. So this is just beginning, just re-accelerating, and you can see it in the Korean exports are still strong, and the rail freight card loads continue to rise. Software lagged semis by the biggest spread over the past 2 years, except during the tech bubble. So that's a pretty big extreme there to start to pay attention to, and we'll start to look at some stuff in software. Equity sentiment is getting warmer, but not really extreme, according to the bull bear indicator at Bank of America. And then quarterly market breadth in Q3 was the widest in 20 years, which is exactly what we saw in 2001 and 2002 before the 3 to 4 year run, which had China, emerging markets, small caps, and value dramatically outperform the rest of the market, while tech had subdued returns, to put it mildly. Equity-weighted S&P 500 inflected higher versus cap-weighted post-June CPI report, and that has persisted. That's just the beginning of the game, not the end of the game. Then we've got our Slumer stuff from RBC, thanks to my buddy over there. And as you can see, it looks like we topped out with yields in the past week at 4.3, and now we're bouncing off that resistance at the 61.8% level. For those of you who care about Fibonacci levels, we are not really one of them, but we pay attention to what other people are paying attention to, and that's called game theory. Then the S&P 500. So, you had this cup and handle. It broke out. It wouldn't be unexpected for it to go back and test the breakout level of 56.69 on the S&P 500. I'm not saying it will, but I'm saying I wouldn't be surprised if we had that. And that would probably make a lot of sense, mostly pre-election, or if the election decision gets dragged out a few days in that uncertain period. That's the kind of thing you could see. Semiconductors have been weak, trying to get off the mat. We'll see if November is seasonally a very strong period for semiconductors. Maybe Intel can play a role in leading some of them out of the woods. S&P we covered, NASDAQ we covered. Gold price, this is at the 261.8% Fibonacci extension level, which kind of confirms what we're saying. You're probably at a top, not a bottom for sure. Copper is kind of just consolidating, looks exactly like the Hang Seng. They call it Dr. Copper because it talks about the global economy, which starts in China demand. And the Hang Seng, you had this huge rally up, as we all know, and now that it's checking back, people are getting nervous. They've all forgot about what Tepper said. God willing, we get a pullback. I'm going to double down again and break my position limits and add more. And we added back all of the option premium on BABA when BABA got back to 95, 96, 97 range. So we're reset for another year plus, and pretty excited about the opportunity that was served up. Trend and cycle technical weekly chart book. See if there's anything new here from Slumer over at RBC. Again, just talking about that check back here to the 5,600 and change level as a possibility. Not saying it will happen, just saying I wouldn't be surprised if it did happen. Mid caps have been consolidating for a few months. They should break higher here towards the end of the year, along with small caps. I think small caps break out in the next 2 months. This is a large cup and handle. So the implied measured move would be from 1,000 to 4,700, so 400 points. His fib level has you at 1,700. My measured move would have you at 1,800. But the name of the game is earnings are going to reaccelerate and support all of this nonsense voodoo about lines and charts. But it just helps to zoom out and take a look at these things so you can see where you are. Here's the weekly Russell. This thing looks beautiful to break out meaningfully and continue to go. So that's going to be your best value to price. Price is what you pay. Value is what you're going to get in the market right now. And all the impatient bobbleheads on TV that keep saying, oh, the small cap trade's not working, blah, blah, blah. Just take the stock away from them and they can buy it from you 30% higher. Hang Seng index here, as pessimistic as everyone is on China, when you step back, the name of the game is you have rallies, you have consolidations, rallies, consolidations, and this will happen all the way up. And the idea is to get the disbelievers to buy at the top, take them out of their stock at the bottom, get them to buy at the top, take them out of their stock at the bottom, get them to buy at the top, take them out of their stock at the bottom, and then they will be the final buyers at the peak with all the gold bugs right now. 10-year yield weekly. He's saying it's not really quite yet overbought, but you have this kind of downtrend line of the RSI or whatever nonsense. The key is November bonds are going to rally. Okay, that's my view, and I'm sticking to it. Could I be wrong and it goes to 446 before it goes to 385? Sure, I could be wrong and it does that. I wouldn't bet on it. As a matter of fact, I would be opportunistically buying TLT, not selling it. Dollar index, again, a different view here, hit this level of resistance. We think it's going to start to weaken again. Could it be wrong and it goes to 106 before it goes below 100? Sure, but I wouldn't bet on it once again. Canadian dollar, it's just putting in this base. I think it's going to break through this downtrend line finally on the next move up. Maybe that starts in the next couple of months. We need an election catalyst. All this stuff is kind of hanging out and counter trend moving and people chasing nonsense. And here it looks like gold has a little move further to 28.17 if you look at his fib extension stuff. Copper just consolidating like the Hang Seng in China before its next move higher. If you want to play on something to break into new highs, I'd be selling gold and buying copper. There's your pair trade for the next 9 months. Sell gold, buy copper. Or sell Fang, buy China. Similar trade. So that's that. And I don't think there's anything else here. NVIDIA pressing up against the double top. We'll see if it gets an extension. You know, it's interesting. November is a strong month for semiconductors, so maybe it does pop up here. But I'll leave that to you guys. All I know is the odds of NVIDIA doubling before many of these other stocks doubling are very low because it would be a fourth of GDP. But I'll leave that to others to chase the last few pennies. Apple, I think it was down a little bit after hours. We'll see how that plays out. Any other key companies we want to cover here? Okay. All right, I think that's good for now from this. Oh, he's got a lot of names in here this week. Okay. Quotes of the week: when stocks are attractive, you buy them. Sure, they can go lower. I've bought stocks at $12 that went to $2, but then they later went to $30. You just don't know when you can find the bottom. That's from Peter Lynch. I too have had that happen with Range Resources at 11, went down to 116 or something. We brought our basis down to 4 and change. Now it's 30 plus and going to 60. Why? Not on a guess, not on Fibonacci nonsense, on the basis of the liquidation value of proved and unproved. Similar situation we're going to see with Comstock Resources over the next few years. Warren Buffett: a market downturn doesn't bother us. It is an opportunity to increase our ownership of great companies with great management at good prices. So those of you who have been with us for a while, you know we consistently do that over and over and over. And here are some indicators I just want to put on a bulletin board to give you an idea of where we may be. Here's the PMO buy all back down to 0. That's always a good time to buy. It's not quite there yet, so maybe we get another day or two of weakness before the election or the election decision. Same with PMO by SPX. This is what you see closer to the bottom than at the top. And then you also see some of these indicators pretty washed out on a daily basis. The NASDAQ advanced decline. This is usually when you get bounces. So given how oversold we are going into the jobs report, it wouldn't shock me if we got a bounce tomorrow based on some of these stretch things. Doesn't preclude the idea of getting 2 super stretch days in a row. The odds don't favor it, so I would be probably looking more for a bounce than a crash. And certainly over the next few days, if not tomorrow. And then you just see some of these great companies that are really beat down, none of which we're buying. We are looking at Dow Holdings, but probably not do anything there because we'd have to sell something else to do it. Nike, someone has a question about that this week. I have no problem with Nike at these levels. It's just we own Vans, and I think there's higher upside of multi-bagger in Vans being certainly a double from our basis, much lower than here, but even a triple plus and beyond versus Nike getting a double would be very, very nice, and a triple probably not likely in any reasonable time period. But I'm all for doubles over a couple, 2-3 years. I think Nike could do it, but I wouldn't have the level of certainty as having Bracken Darrell doing a turnaround situation. So that's why you got to pick and choose. But, a lot of these companies have come down, so you just get a feel of the overall market looking a lot of this stuff. These are things I do on a regular basis. daily basis. Here's from Bloomberg. Intel surges after results spark optimism over turnaround. As a matter of fact, we are going to... Where did I put that? Okay, we're going to go ahead and play Pat Gelsinger right before his earnings call a couple of hours ago on CNBC with John Fort. Here we go.
Intel stock sharply higher right now in overtime, up 12% after reporting results moments ago. Joining me now in a first on CNBC interview before the conference call is Intel CEO Pat Gelsinger. Pat, welcome. I didn't know how investors were going to digest this one. Not used to seeing a non-GAAP EPS loss here, but this has to do with equipment bought COVID timeframe, 10 nanometer that you just couldn't use. Is this over with this scale of these types of charges, many of them non-cash?
Yeah, thanks, John, and always a pleasure to chat with you. And overall, I just say we had underlying strength in the business this quarter, but we had the one-time charges that were consistent with what we indicated on our last earnings call, the major restructuring that we have done, the people actions against the business, and as you say, these one-time charges for the Intel 7 equipment. And simply put, we had too much equipment, somewhat induced by the COVID era expectations of a much larger PC, business at the time. That equipment isn't useful as we move to the EUV nodes, Intel 3, Intel 18A. So we did take this one-time write-off associated with it, in addition to the impairment charges, which are largely accounting charges that are affected this quarter. But when you look at the underlying business, great progress on products, on foundry, a beat and raise. So obviously the markets are responding positively, but our view is, we have a lot of work to do, and we had a lot that we got done this quarter. So a really solid quarter of execution.
Give me the give and take between the client business and the data center business. Client computing was just about in line, slightly less than the consensus, though I think after AMD, investors might have been expecting that. Data center actually did a little bit better than a lot of analysts were expecting out there. What did you see demand-wise?
Yeah, overall, our client business, we made significant adjustments with our customers to lower inventory levels. So we go into the rest of the year with a very good inventory position and a very robust product line for our client business overall. Clearly different segments of the market, like the desktop products, we weren't quite as strong this quarter, but overall, we're on it for the AI PC, our leadership there, very strong launch of Lunar Lake, our Core Ultra product, that just has really set the world right thither on just how strong that product is, battery life, AI performance. And on the data center side, a little bit better than was forecast in that business. And clearly our Xeon 6 product line that is now in the market is starting to gain momentum there. And our overall position for the Xeon as the AI data center CPU of choice has definitely been a positive for that area of the business as well. Overall, very solid product execution.
Quickly, I want to go back to something that you just said, because last quarter you said that you expected Q3 to be tough on inventory, but then that would set you up well for a bounce or uplift in Q4. Has that worked out as well, less well than you expected so far?
Yeah, I think overall the PC market may be slightly smaller, right, as people are looking at the finish of the year. That said, I think everybody is expecting growth in the overall PC market for next year, based on a major Windows refresh, AI PC, a bit more global strength, China economy recovery. So overall, we believe we're very well set up for Q4 and for next year in the level of inventory and our product portfolio with our customers.
Okay, now I'm always asking about it. Tell me about Gaudi 3. I believe that was launching in Q3. You've touted that it delivers 2x performance per dollar on inference and training versus H100. That said, you are selling it for less, of course, and NVIDIA does have Blackwell out. How does the reception look for that product now, long awaited, as you're launching it?
Yeah, Gaudi 3, strong product. And the efforts in having a strong, set of use cases. You've seen that we announced with the IBM, their Gaudi 3 in the IBM AI cloud. We're getting good reception from that. And early market uptake is very strong for Gaudi 3. And we're really focusing it on what I'll call the enterprise TCO inferencing-centric use cases where Xeon plus Gaudi really deliver a compelling offering for enterprises who, really are now saying, that high-end AI cloud training is great. How do I use it, or how do I inference with it? And that's where we're seeing our strength on both Xeon and Gaudi 3.
And we're back. And then want to get to some of these here. And we'll go into Intel more detail probably next week. Jim Cramer says to buy Stanley Black & Decker's post-earnings plunge aggressively. It's not a plunge. It's up from whatever. It's up $70 or let's see. Stanley Black & Decker. They're doing everything they said they're going to do. Top line's still a little soft, but they've taken the costs out. So all that operating leverage will kick in as rates continue to come down and rehab jobs come up. Yeah, from 65 to 92. So it plunged from 110, but it's, all these things are relative, especially when it's going to 200 plus. And we've been in this one and we'll continue to be in this one. And if it did get an 8 handle on it, we could be able to buy it for new people, which would be awesome. But it's not there yet. Intel. Oh, Boeing. Great news after work. Boeing reaches new deal with union in hopes of ending strike. This was right after the close. And so they're going to vote on it on Monday. It's no coincidence they're going to vote on it Monday right before the election, because they may quickly be faced with an administration that is less favorable towards union strikes, particularly when it relates to holding up defense projects for the Department of Defense. So I think that they're going to vote yes on Monday. That's going to be a great thing for the stock. They've raised sufficient capital, and then they can go back to generating a ton of cash. And we're excited about that. Etsy beats quarterly estimates for gross merchandise sales. Board approves $1 billion share repurchase. And this is a relatively small company, so $1 billion share repurchase moves the needle. Their revenues came in much higher than expected, 2.92 versus 2.89. I'm sorry, quarterly revenue came in at 662 versus 652 estimates, and there was a lot to dig into there. So that's a very positive niche, moded business, specialized business. Gift giving does very well in November, December. So we'll probably get a bounce out of that, and then decide how meaningfully we want it to be in the new year. Estee Lauder stock drops on disappointing guidance and cut dividend. I think at this level, you've got a margin of safety. People say wait 2 or 3 days after a big plunge, but I think that that's going to be more constructive. The alternative is you wait to hear the new CEO in their first quarter, but at these levels, it starts to become kind of a giveaway. It has your money. It has your pants size. Here's what PayPal is doing with them. The payments company is joining other finance firms in the vast market for customer data. They've got more than the vast majority of companies. That's going to be a huge free cash flow generator for them. And it's just beginning thanks to Alex Chris. Michael Burry is betting the house on Chinese stocks, and this billionaire investor is too, which is David Tepper. Should you follow them? And the answer is you should do your own work, but it's nice to see all the crowd is running in now that the stocks are up, and they're going to go up a lot higher. Star Chinese fund manager bets on Alibaba liquor stocks for shareholder returns. Okay, welcome to the club. China stimulus aims to boost consumption, top official says. Vice Finance Minister says fiscal moves will be quite large. Lawmakers expected to unveil fiscal package in early November, coincident with the election. Their National People's Congress Standing Committee meeting is scheduled to take place November 4th to November 8th. There's a legal process to go through for China's fiscal policy. So that's going to be a big deal. Bosses are calling workers back to the office. That's good news to landlords. You heard it here first a year and a half ago when everyone said that was not going to happen. We played Vornado for a quick, huge pop, and that game has just started. Intel invests $300 million in China chip packaging and testing plant. Intel and Samsung to explore foundry alliance to challenge Taiwan Semiconductor. It's an oligopoly, ladies and gentlemen. Those are the three biggest. So if they join forces, that could be very positive, both for Samsung and for Intel. China's Gen Zers are into stocks. They are so over the housing crisis. This is huge. This is the beginning days. Opinion follows trend. As price goes up, that's what they'll do. All they've known for the last 20 years is housing goes up. Now that's not happening. They're going to reallocate their funds to stocks, and this game is just getting started. China confidence, consumer confidence seen as the key driver for growth. So that is going to be the theme for that special meeting from November 4th to 8th, where they decide the magnitude of the stimulus. And if it's Trump, it's going to be the biggest fiscal stimulus in the history of China, in my personal opinion. China's central bank adds $70 billion with new liquidity tool. So they're doing these baby steps in the background, waiting for the big bazooka, timed right if and when Trump is elected as new president, which the betting odds dramatically favor at the moment. That's not to say that things can't change over 3 or 4 days, but 5 days. But there's definitely a lot of momentum. So Supermicro stock falls further after 33% drop. It was funny. We've gotten a bunch of Ask Me Anything questions about this stock for a while, and I continued to say, do not chase this and not for me. And they kept saying, but the numbers are so good. The numbers are so good. Well, it turns out the numbers were incorrect, and their auditor stepped down, and the stock is collapsing. So anyway, there are telltale signs you can only have after you've just been around for a long time, and tough for those things to get found out during a bull market, though. So that thing must have been egregious. Their financials must have been a complete disaster, and they're toast on that front. There's not to say there's not some value in the business, but when you're cooking your books and you're a momentum stock like that, you're toast, and it will take years for them to rebuild a stable investor base, no matter whether or how decent their underlying business may or may not be. VF stock, again, these are all accusations, but when a major big three accounting firm resigns as your auditor, it's usually not a sign that the stock's going up. VF stock surges after Q2 sales beat, profit swing. We'll talk about that in detail today. China home sales see first monthly increase in 2024 on stimulus. So all these things are happening. They're all being ignored. They'll all be known when all the stocks are up 300%. AliExpress invites U.S. retailers to sell on the platform. That continues to grow in leaps and bounds. And interestingly enough, many of you know we were a little bit critical of one of the journalists that had covered China for the last 2 years in a very one-sided way. We'll just put it that way. And it seems that they've shifted the coverage to a more balanced reporter who started their first article on China with Alibaba stock has soared. It's still cheap enough to buy. And she goes through a bunch of the data and the cloud story and basically everything I've been saying about the stock and the growth prospects moving forward. So that's nice to see some more balance. That's what I expect from Barron's. That's why Barron's is my favorite financial publication, and I think the best publication in the business. And it's nice to see that they're getting or staying with that theme. Versus getting sidetracked. China's economy shows flashes of stimulus taking hold. And the article of the week is pay or play stock market and sentiment results. So we have Will Ferrell on the horse with the PayPal app, and we have the vans, the new vans that I got last week, and the company doing incredibly well. As it relates to PayPal, they beat on the bottom line and raised guidance. The revenue miss was due to intentionally discontinuing Braintree revenue. That was either low margin or no margin business. This Wall Street Journal article by Telus Demos, which is also a superlative publication, summarizes why the stock was red after reporting earnings and why it might see a lot of green in the future. So, as he says, PayPal says it is sacrificing some volume growth to focus on the more profitable payment flows. The market doesn't like the look for that for now. but investors may come to embrace it if similar moves at other payment players are any guide. So what they've done is Braintree is the non-branded stuff. They've increased the margin by adding value services, the different checkout things we've discussed, the data business, all the other things, so they can make it a high margin business. The part of the business that they were pushing through there that is low to no margin, they've just decided we'll just take 80% of your business that's profitable. You can give the no margin business to someone else. So the Wall Street got upset that revenues didn't grow as fast. But again, this is exactly what they did with the unprofitable customers in Latin America. You remember when he came in, he just fired them all. And now they're back to growing profitable customers, and they're back to 432 million. He's doing the same with this side of the business. And Telus says similar shifts in emphasis have been winning moves for shares of other payments players lately, including Affirm, buy now, pay later provider. Its shares are up 149% over the last 12 months. Aiden, which spooked the markets in 2023 by warning about increasing competition and commoditization in payments, likewise shifted focus and has seen its shares jump 128% in the past year. So this is a proven playbook. Alex Chris will do it better than all these folks have done. But in the interim, he had total payment volume up 9%, net revenues up 6%, operating income $1.5 billion up 18%, operating margin up 18%, 18.8% up 194 basis points, transaction margin dollars up 8%, and raising their full year non-GAAP guidance. So all of these things are clicking. Their teams drove transaction margin dollar growth, and Braintree, because they cut off the unprofitable revenue, started contributing again to margin dollar growth, which they hadn't before. They also ramped up Fastlane and improved the branded experience across the U.S. partnerships with key players like Fiserv, Aiden, Amazon Global Payments, and Shopify. These are all new partnerships that have taken on their Fastlane because it's better than anything else and it dramatically improves conversion for everyone. So they're licensing it because they can't duplicate it. And that's what makes PayPal just leaving the station. Guidance raised for the full year reflects not only the third quarter outperformance, but also a constructive, slightly more constructive view of the fourth quarter compared to what was implied in our last guide in July. This is driven by more favorable view of transaction margin dollar growth, which we plan to reinvest near term back into strategic initiatives and marketing that are aimed at driving long-term durable growth, i.e. some of that's going into Will Ferrell's pocket to hop around on horses and tell everyone that he wants to pay from everywhere with all the rewards apps and the Venmo and the PayPal app and getting mobile right. And this is very much like Facebook in 2016 when everyone said they didn't get mobile, they missed it, and then they got it and everything took off. PayPal is doing the same thing with payments. Their mobile game is going to the top shelf from the bottom basement floor is where it was when he took over. Free cash flow from operations was $1.6 billion and free cash flow was $1.4 billion. So they continue to buy back stock. They returned $1.8 billion to shareholders by repurchasing approximately 28 million shares of stock. This thing is going to continue to generate more and more cash and continue to shrink the float. And one day you're going to wake up and it's $130 and then it's $180 and then it's $200. And everyone says, wow, I remember that when that was a $58 stock when Tom was talking about it on his podcast. I can't believe it. Some of these things are obvious. You just have to be patient and you have to be in the game. So it's had this big move from 58 or 60 to 80. Now it's going to consolidate in the high 70s before making the next move up. But the key is it's gotten through the hard stuff, and now it's going to continue to raise guidance, continue to execute, continue to build profitable, sustainable growth. And you can see on a line-by-line basis, everything is moving in the right direction. Whether it happens too quickly on one metric for the Wall Street sell side or not quickly enough because people can't wait 2 or 3 months does not concern me. I have a great company at an unbelievable basis, and we're going to ride this thing just like Will Ferrell on his horse, paying from everywhere. You can see him in the ad there. 1 million new PayPal debit card enrollments since September launch. I mean, you can't make this stuff up. It just, everything is humming here. Active accounts are up. monthly active accounts, number of payment transactions up. Transactions per active account are up 9%. So not only are more people using it, the people who are using it more frequently because they're giving them more rewards, more cash back than anywhere else. And that stuff starts to multiply geometrically. I want to go through some of these here. Evolve from a disparate payment products and point solutions into a powerful commerce platform. As we shift from payments company to a commerce platform, more of the world's leading commerce players have partnered with us to add value for our mutual customers. Over the past 2 months, we've announced partnerships with Fiserv, Adyen, Amazon, Global Payments, and Shopify, and we're actively discussing more collaborations in the industry. These new and expanded relationships are a clear demonstration our brand and innovations and momentum are resonating. So that's that. New product experience are resulting on average more than 100 basis points of conversion lift for the vaulted checkout and up to 400 basis points of conversion uplift for one-time checkout. We're also seeing a 15 to 20% increase in buy now, pay later use. So all this stuff, ladies and gentlemen, is staggering how quickly they're ramping it up and getting it adopted. Second consecutive quarter in more than 2 years that Braintree is meaningfully contributing to transaction margin dollar growth. That came from doing those things that the street was angry at them for doing, which is basically firing non-profitable, negative yielding business and only dealing with profitable, higher margin business by adding value add versus being a commodity provider. The scale of customers who are primed to spend with PayPal puts us way ahead of other guest checkout solutions, and is one of the reasons why so many platforms are choosing to partner with us. We can't wait to get Fastlane into the hands of more merchants, not only on Braintree and PPCP, but also through our partnerships with Fiserv, Adyen, Global Payments next year, moving to small and medium-sized businesses. Last month, we launched PayPal Complete. Complete payments in new geographies, including China and Hong Kong, with more markets on the horizon in 2025. So they've just launched in China and Hong Kong, ladies and gentlemen. That could be very constructive for them in the context of the China recovery, the China stimulus, and the China consumer coming back. So that's a positive thing. The PayPal debit card. In addition, these debit card users are now choosing PayPal branded checkout more frequently when they shop online. Early data from our existing customers shows a 5x increase in total omni spend within the first 2 weeks of sign up. So, I mean, these are things you don't hear anywhere else. I mean, this is the key. The sell side was pissed off about transaction take rate declined by 4 basis points to 167 compared to 3 basis point decline last quarter, but they talk about the improvements in Braintree and Venmo monetization. That'll come back. PayPal generated $1.4 billion of free cash flow. Finally, we ended the quarter with $16.2 billion of cash and $12 billion in debt. They talk about the trade-off. Also Q4 is off to a good start. Consumer feels very strong to us at this point, so all that's positive. Some questions from the analysts. Let's see if there's any big things here. We talked about the margin and checkout conversion, etc. Now on to VF Corp. 1 year ago, I was on the Clayman Countdown on Fox Business talking about the turnaround that would come at VF Corp. It is now coming to fruition with a long, exciting runway ahead. Those of you who know, it was up some 27% in 2 sessions right after earnings, and has stayed above $20. So you can listen to when I was pitching Liz when it was $15 a year ago, and we're just getting started. And now we're going to listen to Bracken Darrell joined Jim Cramer on CNBC following the earnings call yesterday. Here's what he had to say.
Phenomenal quarter from VF Corp, the footwear and apparel powerhouse. You might know them as Vans, North Face, Timberland, Dickies, many other brands. Those numbers sent the stock up 27% yesterday. Tax on another 3% today. Holy cow. As management held an investor event here at the New York Stock Exchange. Earlier today, I got a chance to sit down with Bracken Darrell, the president and CEO of VF Corp, whom you might remember from when he ran Logitech, where he created an insane amount of value. Can he work the same magic here? Take a look. Bracken, I was worried about VF until I heard that you were taking the helm. I knew you turned around Logitech. I know you were not wanting to hear Mouse Guy takes over fashion company. But the truth is, you were made for this job, weren't you?
You know, look, I'm in heaven here. I mean, I'm surrounded by amazing, iconic brands and an incredible opportunity to create great products. I mean, I just love this stuff.
Now, you're laying things out, and today was a good layout of the medium term. You haven't laid out the brand yet. However, you did make it clear in a series of what I regard as very candid comments. If we say it, we do it. What did you say, and what have you done?
Well, what we said was we were going to bring down the debt level by selling some assets, getting our inventory under control.
Even a good one you had to sell.
That's right, and we said we'd sell a brand asset. We did. So we said we'd sell some assets. We did. We sold planes, hangars, real estate. We sold Supreme, which is a fantastic asset, but didn't strategically belong in the portfolio. And we said we'd lower costs. We took it down by $300 million. So what we've been saying, we've been doing.
Now that matters because one of the things that you have is talking about a compelling value proposition. You're trading significantly off sustained historic highs, highly levered with a clear path to delever. And then I thought this was incredible. Operating income, when you've come in, historic lows.
Yeah.
What a is this the Jay Stables you got here?
You know, I think anytime you're lucky enough, like I've been a few times, to be brought into a turnaround, your temptation is to look at the short term and say, wow, we can flip this really quick. I've learned, you know, the real secret to turnarounds is think long term. And so the opportunity is to really dramatically improve those operating margins. But the cool thing is, the really big opportunity for long-term investors and the reason I'm here is long-term, strong, profitable growth. And that's what I'm really building.
Well, I remember when you first interviewed at Logitech, which was really just a spectacular run, everything excited you. When I hear you now, you talk about how much you like a Timberland boot, that you were so excited about Dickies. Tell me. You go.
How can I not be excited?
But I'm going to give you a little thing because my parents were from the fashion industry.
Yeah.
What the hell are you doing charging half for everything in it when it's better than the guys who are charging whole? I mean, I look at the Dickies, work pants, $35, and then I go to that Carhartt. Yours are same as Carhartt, but if they're half price, is that correct?
I'm sorry, I've got to correct you. Ours are better. But to answer your question, look, one of the reasons I came to this company, I could have done other things. I came here because I didn't want to be in luxury. I wanted to be in products that could sell to everybody. You know, I grew up in Kentucky. I grew up with a single mom. I love this world of where you walk in the street and you see people wearing your stuff. You don't have to walk into the high-end fashion mall. And so I feel so at home here.
Now, I do want to just get your impression of my impression. I think that you have a brand. You go to Europe, okay? I like to go to Europe. It's pretty cool. And all I ever see is North Face. I see North Face, North Face, North Face. I go to Kerdam, okay? The nicest street in Berlin. They're lining up for North Face. And the last probably 8 conference calls before you got here, I never heard North Face. How is that possible?
You know, North Face is a phenomenal brand. We've really performed well in Europe, very well in APAC. Not as well here. That's the reason you didn't hear about it. But
why?
But we'll change that. So I think at the end of the day, we're running a different operating model in the rest of the world than we were in the U.S.
Right.
And that created it made us bureaucratic and slow and not as effective. Now we've changed it. We've brought the European operating model into the Americas.
That's what I see.
And we're going to get our mojo here.
Okay, so what do we want to be? How much online? How much brick and mortar? How much Walmart? Hey, which you and I both know is not the Walmart that people think it is. No. It's cool as all get out with the big Dickies display. How much Costco? How much everybody else?
You know, look, one thing, the underlying principle of all this is we want to sell where people are buying, where people come to shop. So we love the retailers, they're multi-brand retailers, because who's coming in there? When you go in there, you're thinking, okay, I might want this brand, I might want that brand, I want this category. Got to be there with great product, great marketing. We also want to be, when people are loving Dickies or loving Vans or the North Face or Timberland, we want them to be able to go online and buy or go into one of our stores and buy. So we want to be in all those places and let the consumers decide what the proportion is.
Now, I believe that you obviously have to work about markdown management, absolutely right. Positioning of global brands, absolutely right. But you're an inventor. I have never seen you come on my show and not have 7 new things, of which I then got, and my life was better, including those I still wear, the great earbuds, which is like a little better than somebody else's. What do you got in mind? What are you thinking?
Well, look, the most...
Oh, give us something. You're going to give me something.
Okay.
Come on,
All
give
right.
me something.
The crazy fun thing about this industry is that there's so many things you can create. In 1 year, this has become the number 2 shoe sold in Vans. It's called the new school.
I thought Vans was dead.
Oh, Vans is not dead. Vans is coming out. Vans is going to be strong.
Now, okay, so I go into Mary Dillon, I know you love her, Foot Locker, and that's Nike. Slap Nike on that, and it's a $250 shoe. What are you going for here?
Well, we're going to sell. You're going to buy our stuff as much as $129, $149 if you want a really specialized functional shoe. We have a lot of upside room actually on pricing.
Right.
But we're also going to be available in meat and potatoes price points so everybody can buy. One of the hottest things in styling is high-low. You wear your Louis Vuitton bag, you wear your Vans shoes.
Yes. Oh my God, yes.
This is I'm quoting Sun Che, who runs Vans, who came from Lululemon, best product person in the industry. Hey, this is the world we're in now.
No, I see Bob Kraft with the Air Force Ones, and he's wearing a tuxedo.
I got to get in touch with Bob. He should be wearing Vans or Timberland for sure.
We'll call him after this, definitely.
Yeah, we'll do that.
All right, so time frame. How much is? I mean, already you've blown it away. I thought that you'd have to have a year of redding, and then the stock goes to 12, and then you start the launching pad. You're already at the launching pad. What's next?
This is look. As I said in the beginning, the one thing I've learned is, to really turn around a business, you should be thinking very long term, because otherwise everything you do just comes undone.
Right.
So we're changing almost every variable inside the company and synchronizing it, and that's going to start to click as the years go by, and over time we'll become a growth company.
Is it fun?
It's incredibly fun.
Discover something new every day among these brands?
I am just having a ball.
Bringing in inventive people? Turned out to have a lot of great people already.
We've got great people inside, and we're bringing great people from the outside.
Well,
too.
look, it is so terrific to see you with an iconic company that I have loved from when it was Wyomensing in Pennsylvania.
Yep.
Where we go and we fight over a pair of jeans
right.
at the bottom of a cardboard box. Remember, it's terrific. $5 for a pair of jeans that lasts for the rest. They're still in my closet. Bracken Darrell is the president and CEO of VF Corp. I am so thrilled you're here.
Thank you.
Coming up.
And we're back. So effectively, they have improved beyond what they had anticipated they would improve in terms of the year-on-year declines are now narrowing, and they're going to start to be we're going to start to see year-on-year flats, and then we're going to start to see year-on-year reacceleration and a growth story start to happen, and that's a big thing. Gross margin was up 120 basis points. EPS was 52 cents versus negative 116 last year. Net debt is down, but they got $1.5 billion in from Supreme, so it's going to be down a lot more. And for Q3 2020, fiscal year 2025, expects on a continuing operation basis revenue in the range of 2.7 to 2.75 billion, down 1 to 3% year over year in reported dollars. So this is really narrowing from double digits down to low single digits. And then we see obviously APAC and China was up bigly, 6%, despite what everyone else is saying, and that's been positive. Expanded gross margins, they go through all of this stuff. New school is selling out everywhere, which we've covered. Sold out in 5 minutes upon the launch in September. Super strong comparison, back to school. North Face is strong, hitting on all cylinders. Greater China continued its strong momentum. And let's see here, we're running long on time. And then the investor days when the stock really took off. Talked about long-term sustainable profitable growth like he did with Jim Cramer, transforming its company, performance category, adjusted gross margin back up to 55% and how they're going to do that, operating margin back to 10%, net leverage 2.5 times or below. And then you can see some of the slides from the Investor Day, which came after the earnings day, and you can see where gross margin is and where it's going and how they're going to get there, is through reduction of SG&A and getting that operating margin back to 10%. And 9 focused work streams in action to drive $500 to $600 million of operating income expansion. And they go through the game plan. So this is not, finger in the wind and hope that they get it done. They are hitting on all cylinders, and they're delivering on what they said they were going to do from the moment he came in that first quarter with the conference call, which has really been amazing because you really don't know what you're dealing with when you just come in. And the fact that he did know what he was dealing with, and he put together the plan, and he's been executing it and getting that European platform that works so well into the US and implementing it across brands and having collaboration across brands is a big deal. So what we've done, key account partnerships, cross-brand execution, segmentation and elevation, what we're seeing, growth and share recapture, quality of growth and inventory health, finally. And you can see at their peak, they were at 55% gross margin and 13% operating margin. Their first test is to get back to 10% operating margin and 55% gross margin, and then they'll grow for here, quality growth. We don't believe in high leverage. We'll continue to reinvent ourselves to get back to that 10%, reduce leverage. We are here for growth and to see an acceleration of revenue trend, reduce leverage and build a sustainable long-term shareholder value, reinvent and grow. Fear and greed is kind of in the middle of the pack. It probably came in a bit more today. National Association of Active Investment Managers dropped a little bit, but let's see how much fear came into the market today. My guess is not as much as you would hope. All right, so it dropped into the fear zone at 44, down from 58. So that's a move in the right direction. Defense and aerospace earnings, top 30 weights. Estimates were down 2.03. Probably some of that has to do with Boeing. Yeah, and then once that strike gets resolved, those estimates will start to go up over time. Energy earnings, we saw before, that's going to be the worst sector, down by 14.89%. Wow. Which companies are getting shellacked here? Murphy, CTRA. It looks like the smaller players. Fang, that's Diamondback. Occidental, big, getting hit. Valero. The refiners. Phillips 66. Chevron. Yeah, so they're all down a lot. ConocoPhillips. Okay. Economic data, we went through enough of that. Earnings continue to come down. I think we're going to see these estimates go back up after the fourth quarter, but keeping an eye down from 278 to 275. And now we're going to get to our Ask Me Anything questions. So for those of you who don't stick around for the Ask Me Anything, thanks for tuning in. We'll be back next week. For those of you who love the Ask Me Anything questions, here we go. We got a lot of them this week. Kyle M. Hey, Tom, I'm sure we'll cover it in depth next week, but any initial thoughts on Cooper Standard earnings and guidance? I hope they do terribly so I can buy more stock. How's that? I don't know. I mean, I don't really spend a lot of time guessing what they're going to do on a quarter-by-quarter basis. All I watch is incentives and SAR, North American SAR. So Ford is implying that the SAR is going to be a little stronger than everyone else thinks. If that's the case, Cooper Standard will do better. I mean, if the volumes come in, Cooper Standard, they've got that thing run like a lean, mean fighting machine. And if as that SAR gets over 15.8, their cash flow break even. Every couple 100,000 cars, they're going to just mint money. So that's how I think about it. And if it's this quarter, great. If it's not, I'll buy more stock. And then if it's next quarter, I'll just have more stock when it goes back to 25 and beyond. Paul Apasta. Hey, Tom, thanks for the information you provide. I've told a bunch of friends and family about your channel, but most are a bunch of bums and don't invest at all. Well, Paul, I would just suggest you become who you hang around. So, glad you're with us, and hopefully you can get some great other people, like-minded people around you in your life that'll help you in your journey to improve. But I am grateful that you're recommending it with your friends and family, because that's how we grow. And for all of you who are not clients yet, the best way you can contribute and make sure that we continue to provide this for non-clients for a long time to come is share it, because the bigger it grows, the more incentivized we are to continue to put this out on a regular basis for non-clients. My question, if you haven't commented, any initial thoughts on Cooper Standard? Well, okay, it sounds like everyone has the same question. Yeah, same answer. Hi, Tom. I know you said before you wouldn't consider Nike since you have enough China exposure through Alibaba and Goose. What price would you say it's undervalued? I mean, I would look at it here. I think it's okay. You're never going to get the exact bottom, and the market doesn't care where I think it's undervalued. But yeah, I would be a buyer at these levels, I think. Let me just take a look. Yeah, this one's probably going to be fine. So that's on the short list. Okay, next. Estee Lauder, we covered already. Paul Davies. Curious why you think the Canadian dollar. We covered all that. Let's go on to Novo Nordisk. This is from Paul Davies. Okay, I was wondering why he was coming to me with Novo Nordisk. He is a new listener, so I want to welcome him in. He is recommending a stock that's up 10x and has corrected 20% in Novo Nordisk. I would say pass. There's a lot of competition coming into the GLP-1 phase, which we talked about last year when we were getting pessimistic on, not last year, this summer when we were getting pessimistic on Eli Lilly. And we went on Yahoo in that segment where they make you talk about one stock you like and one stock you would not want to be buying. And so it's come down from 972 to 829 over the last couple months. I think you're going to see more and more price competition. So for me, as great as Novo Nordisk has been in the rearview mirror, I'm not a fan prospectively. Landon asked about Estee Lauder. I think it's getting cheap enough here to put a starter position, and then if it goes lower, buy more. Drew, same story on Estee Lauder. Wilhelm, same story, Estee Lauder. Tim is asking which options we buy for Alibaba. That's for my client's benefit, but they're long dated. Matt in North Carolina, very grateful for your advice. Okay, so he's asking about Advanced Auto Parts. Advanced Auto Parts has done everything that they said they were going to do, so no change there. We top up a few shares every day that it's weak. Same thing with Goose, no change there. So far, both companies have executed on everything they said they were going to execute since we got involved with the turnaround. And the market's just not ready. Look, Advanced Auto told you that the next 2 quarters were going to be soft. Is that all priced in yet? I don't know. It could go lower before it goes higher, but you're moving into a period where all of the leverage small caps start to run. So if it's not an egregious quarter, and Shane O'Kelly, who has a history of winning with Home Depot Supply, and we're betting on the jockey here, turning around the supply chain, rebuilding the relationships with the professionals, I think it'll be okay. There hasn't been an auto parts supplier that's had a great quarter this quarter, so it's probably not going to be fantastic. But I look through, and if you look at, it's funny. I remember when Meta fell, and I think we said at it was around 150 that we started saying it looked very interesting. And we did nothing with it, and we wound up buying Google and Amazon and made a ton of money on those. But it dropped, at 150, it made sense on every economic metric, just like Estee Lauder makes sense at $70. Doesn't mean it doesn't go to $50 before it goes back to $200. So that's something you have to keep in mind. To get the benefits of multi-baggers, you got to deal with the short-term volatility, which is why you use low to no leverage. You know what you own, and you stay on top of it. It's interesting. In the article of the week, I go into extensive detail, which is like, I don't know, 10% of what I do on a company, if that. But it just gives you an idea, like a starter point where to start to do stuff. And I go into a tremendous amount of detail, and it takes a tremendous amount of time. And I do it because I'm responsible for my clients' money and generating returns over time. So you get the benefit secondarily of that work. My clients get the benefit primarily from that work. But I did notice that a lot of people didn't even get through all of this stuff because they're just looking for the quick cookie that they can eat and get their sugar high rather than doing work. And that's a guaranteed formula to continually lose in life, taking the shortcuts. And the way I could tell that was based on how many people had viewed the article versus how many people had listened to the full interview with Bracken Darrell. And it was like, I want to say 100 to 1. So what it just tells me is that the vast majority of participants were not detail oriented enough to take 5 minutes, but they're willing to, maybe willing to put their money on that. So for those of you who are kind of like do-it-yourselfers, just note that you can't expect to get great results without a massive investment of time and understanding. And that's why consistently on average, the retail person gets shaken out at the bottom and they buy the top, and they're chasing gold right now. And they were chasing NVIDIA in the summer before it corrected 30% from June through September. So look, what we try to do here is just give you a durable, repeatable starter point for a framework that you can apply over time. And if you eat, sleep, and breathe this, you can do fantastic over time, being patient. And that's really the name of the game. Buying quality, knowing what you own, and playing the time arbitrage game. JTS, what are your thoughts on buying TLT here? Either as a short-term tactical trade or longer-term holding as part of fixed income allocation? I think it's great. I think we got a nice little pullback, and I think we're ready to flip the switch here. Kyle Filipovic says, I know you said before you wouldn't consider, I think you just sent me the same question twice, if that's not the same person. Blah, 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 blah. Do you see the dollar reversing anytime soon? Yes, we covered that. Sagar Kanakia asking about Capri, which is the owner of Kors, Versace, etc. Let's take a look at Capri. CPRI. All right, so they're, the stock is following their cash flow, which has been not good. Their gross margins have been not good. I would have to understand these brands better. I mean, it has come down a decent amount. Let's take a look at the balance sheet. Do a little bit of, see if they're going to be around to turn around. So they got 200 million of cash. Let me make this a little bit smaller here. $200 million of cash, and they have 1.2 billion of debt. So a little bit levered there. Let's see. Still generating cash. Yeah, I mean the issue is their sales are still below pre-pandemic levels. I think this one is worth starting to do work, but you're going to have to do a lot of work because it just seems like it's been a non-productive asset for many, many years. I mean, you're basically, it's been in kind of a downtrend, never really catches up. It seems like based on how the stock has acted over the last decade, it just appears to have consistently poor management and capital allocation. So it just gives me pause that it's never really had a good run. So I'd just be worried about that cigar. I think your framework is close, but I think for me, this one is probably a pass, even though it could work as a trade. Would you mind revisiting SoFi? David, I have zero interest in SoFi, so no, I would mind it. I appreciate you listening, but it's not a stock for me. And when I reemphasize that certain stocks are not for me, there's a reason for it. Michael Heidenrich, enjoying the podcast and appreciate the useful information from week to week. NTR. Okay, NTR. That's from Michael Heidenrich. All right. NTR. Okay. All right. So the stock has come down with cash flow and revenues. This looks like a lot of the ag stocks. You know, here's another one, though, that's literally done nothing for 15, 20 years. Let's just understand why. Is this a fertilizer company? Yeah. These companies, even Mosaic, I keep looking at, and Bungie was one. They just never get runs. They're just like these companies that keep picking their head up and get smashed down like whack-a-mole. So it's not a good enough quality business. It's too cyclical and unpredictable. But I definitely see why you chose it, and it probably works for a trade, but it's not something I want to have capital in for multiple years. Also, in order to take advantage of the biotech sector, do you recommend ETFs, XBI, or are there better expressions to consider? I like XBI because you can't really predict when things are going to get approved. So you get a basket of them when the sector's out of favor, and then rates go down and you make a ton of money. So we still have a material position, and it's halfway there, and it's going to go another double, I think. Not a double, but from where it, I'll just pull it up. XBI. Yeah, so you had this huge drawdown in 2022, and then it rallied, and we thought we were geniuses, and then it went back and tested it, and now it's breaking out. And we think it's going to, work its way higher up to 120, 140, and then we'll see what the world looks like there. And maybe it pushes back to new highs over the next couple of years. So we like this. It's moved a lot. We're grateful for that. But we do think that there's a lot more left in this investment. So we're pretty excited about that. Thanks, Bob. Alan Bodie, thanks, Turnaround Tom, for sharing your wisdom with us on the weekly. Although this isn't a turnaround, have you looked at Universal Music Group? Bill Ackman has a $5 billion position, and it's currently his largest position. I have looked at this. I don't like it. No, Universal Music Group. Let me put it in here. Yeah. Yeah, this is not the type of business I do, so I'll just leave it there. Not for me. All right. Aaron Hoaxa, thanks for the job you do. Question I have, important for us based on your experience. If you want to share 3 best books you'd recommend that we read, I recommend the same thing to everyone that's just starting out. Read Intelligent Investor by Benjamin Graham. If that light bulb goes off, read Security Analysis. And if the light bulb goes off, read every annual letter that Warren Buffett's ever written since his partnership days in the 50s. Follow through Berkshire Hathaway. You can get most of those on his website, and the rest you can just Google search for. Margin of Safety by Seth Klarman is pretty good as well. Are you able to talk about KRE? Well, we've owned it for a long time, so I don't know what is not to talk about, but this was one of our big buys in 2023, and we continue to hold, and we think this will work to new highs. Valerio Pomoni, do you have any thoughts about New Fortress Energy? No. Let's take a quick look at it, but my instinct is stay away. Yeah, cash flow continues to burn. So they have $7.4 billion in debt with $133 million in cash. That's your problem right there, my friend. This has a super high probability of BK unless they start selling off assets very quickly. So for me, it's a pass. It looks like it was a promote. Not interested. Jack Z. Glad to see Bob has started to move. Excited to see what CCP comes out during the National People's Congress in early November. My sources are saying fiscal stimulus will be a percentage of Chinese GDP, which will be the largest ever, but we'll see. My question for you this week is Coursera. Someone asked about Coursera. I don't like those type of businesses, so I'm going to pass. And Clear Secure You. We've covered those in recent weeks. Both of those are passes for me. I have no interest in those. And you. Yeah, it doesn't mean they won't work for trades, but we're not going to be involved in that stuff. And that's it. So we'll be back next week, same time, same place. Thanks for tuning in. In the meantime, make it a great one. Bye for now.